Hello everybody, welcome to the TraderMerlin Show. It is your Thursday edition. Pretty excited for today. Over the past few months, we've had a couple different shows along the same line. You may recall back in May, I did a show with Bill Addiss called The $4 Trillion Gamble and had this bloody graphics and looked just ominous and horrible. And of course, it had the Federal Reserve logo sitting up there because, well, they were the culprits behind that $4 trillion gamble. Back in August, we did one called The Case for Rising Rates, talking about what Bill was terming as the steepening, and we'll get into that today because, as you've seen by the graphic, today's show is called Interest Rate Steepening, as Katie told me. She says, Halloween has passed. Yes, there is no timeline on the nightmare that the Federal Reserve can create. Joining me from the East Coast, I think he's East Coast, he's up in New York City. Well, not the city, but he's up in upstate New York. We've got Mr. Bill Addiss joining us today. Bill, how you doing?
I'm doing great, Merlin. Good afternoon to everyone from Buffalo, America's winter wonderland.
Hey, you know what? Cheers to the Bills. As long as I've been alive, it's always been kind of a laugh at the Bills. But now, hell of a team, man. Hell of a team.
Yeah, we're always good till the fourth quarter or, the end of the season.
That's right. Well, I'm optimistic. I think they're going to do good. And hello, everybody that's joining us. Thomasina, Jorge, Ivzy as well. Again, Ivzy, thanks for the contribution the other day. Jerry, Dana, Terry, good to have you. Tom, as usual. Sam as well. Kevin, Naum, got the big group in here today. All right, let's maybe don't need to recap, but we can start talking about this interest rate steepening, and maybe for those that haven't heard this before, we can talk about the mechanics as to why that graphic that I drew shows such a big spike on the right-hand side, which would be reflective of the longer-term maturities. What is going on right now, and why should we be, cognizant of this nightmare unfolding?
Yeah, and honestly, it's a nightmare only in terms of if you're looking to borrow money.
Right.
But, it is unprecedented, and I'm kind of like you, getting sick of using that word. But we continue to have an interesting phenomenon, and what I like is it's happening so transparently, and specifically, it's the prospect of longer-term interest rates going up. One of the problems I have is when you talk to the press or you listen to talking heads, they talk about interest rates as if it's one universal thing. Interest rates are going up, interest rates are going down. Well, specifically, let's talk about maturities for just a moment. So if you look at the yield curve, which is just a graphic representation of interest rates, the phenomenon we've got going on here is the Fed has told us with unprecedented clarity that they're going to keep short-term rates at zero. Right. The Fed funds rate, we project going out at least 2 years is going to stay at zero. The Fed has never given us that degree of forecast and transparency. So, it looks like the short end rates are locked in here at zero. But if we go out to the longer maturities, we're dealing with supply and demand 101.
Right.
In just a moment, we're going to talk about this huge deficit. And that means the government is now having to borrow more money than they ever have. We've got an unprecedented amounts of treasuries being sold into the market because we've got an unprecedented deficit, as we're going to talk about. And it's supply and demand 101. Treasury Secretary Mnuchin has told us they're going to fund this deficit with long-term debt. Yeah. They're going to issue long paper. And honestly, I think that's a good idea because long-term interest rates are so low, relatively speaking. Why not lock it in? I'm not glad the government's borrowing so much money, but at least we're borrowing it cheap.
Right.
So we've got, the phenomenon that short-term interest rates are locked in here at zero going forward, and the Fed's told us that. But we've got all of this supply of treasuries coming into the market. Mm-hmm. I mean, this month we had a record 10-year auction. We had a record 30-year auction. We had a record 5-year auction. Every month we're having record-size auctions because we got to fund that deficit.
Yeah,
and it just comes down to, I know I'm speed talking, I'm sorry.
No, it's great. It's actually, I wanted to chime in because it's funny because when I had you on in May, you were saying, we're having record 10-year auctions. And then I had you on in August, and you're like, it's a new record for auctions. And now here we are in November, and you're like, it's another record. And it's crazy. So let me show you guys, and maybe I can explain higher level why that's needed. I know many of you guys understand this, but because of COVID, because of other situations, economic crisis, not just the Fed having done a lot of, we'll just say stimulus, but also the federal government has. And all of a sudden we're left with this situation where we have so much debt that there needs to be a way to pay the interest on that debt. So let me show you a couple charts here real quick. I know I had the animated yield curve up there, which is a great one, by the way. But take a peek at this full screen. This is the monthly cumulative deficits, just comparing 2019 and 2020. And I think that we could all agree that most likely the government's going to run at a deficit, right? They're going to be losing money along the way. And you can see that top line, which I think is pinkish. I don't know, I'm colorblind. It shows a slight deficit to start back in October, and then for the full year, 2019, you can see it drifting down, but still ending at about, looks like $700 or $800 million deficit, or billion dollars, excuse me, million, billion, whatever. But if you look at the 2020 line, notice what happened since March when they started really doing stimulus. Now, in order to fund that financial obligation, there has to be a way to pay that interest, and because you got to pay off that debt somehow. Now, this is why we're seeing the record amounts of bond auctions. And it was interesting because we usually had the 10 and the 30. Those yields have all steepened, which is what we were talking about, interest rate steepening with Bill for the past few months. But also the introduction of a 20-year now, which for them, it's like, okay, well, we can maybe spread a little attention to something else and give ourselves another thing to sell to the public. Now, we are all supply and demand traders. I'm guessing all of you are. And if I have 10 sellers and 10 buyers, price is going to go sideways. If I have 10 sellers and 5 buyers, price is going to go down. In this situation, what we have would be like we've gone from 10 buyers and 10 sellers to 100,000 sellers and 10 buyers. And that's the situation here when they're flooding the market with these bond offerings. Prices of bonds are dropping, therefore the yields need to be more attractive for people to buy into those. And to me, that creates a bigger problem, does it not?
Well, you've got two problems. Number one is you don't have enough buyers, so interest rates go up. But then, your whole cost of financing this that goes up. The problem is the government is already spending the third largest item they have is in line item expense is interest on our debt.
Right.
And that's with interest rates so low. What's going to happen when these interest rates go higher?
They won't be able to make it.
That's it.
I know that this is probably one of the things that you've been in this bond industry for so long. So long. Since the dawn of time, Bill has been. You just came out of the womb going, "What's the yield rate today?"
The first bond I itched in stone.
Right. When we look at the market for interest rates, and you look at treasuries, you look at bonds, obviously ratings become critical. One of the most foul, evil, devious things that could possibly happen in a bond market is to be downgraded. And we've talked about the downgrading of debt a bit in the past. I don't have any graphics here today, but I know this is totally speculative and hypothetical, but what happens if this continues to accumulate debt at such an astronomical rate, no one's buying our bond offerings? At what point do we get a default, and how do you think that could impact our markets?
Well, that's a great question. And, I tend to be pessimistic, but I'm not pessimistic enough for a default. But it's a great question. But I also have to, for the audience, really have to explain, we kind of have a rigged system here in the U.S.
Yeah.
We will always be able to sell all the treasuries we need to. You might remember back in the financial crisis of 2008, there were countries that literally couldn't find buyers for their debt, Portugal, Greece, and so on. And for a government not to be able to borrow money is catastrophic. We'll never have that problem because we have a rigged system here in the U.S. When the government sells bonds at auction, to finance the deficit, we've got 24 firms here in the U.S. that legally, literally have to buy them.
That's crazy.
And they're hostages. These are called primary dealers. And I'm oversimplifying a little bit because they have volunteered for this process. So as a primary dealer, even if nobody else in the world were to buy a treasury, every time the government comes to market with one, these dealers are forced to step up to the plate and buy them. So, I don't know how long that would go on, but presently that's the way the system works. So we'll never, under this system, have a failed auction. The question is, what interest rate does the government have to pay to borrow that money, right? Just as you were saying. If nobody wants the treasuries, that means the rates are going to go higher to attract buyers.
Right. It's a simple example I'll give everybody is I was looking for these things. They're called power blocks. They're a weight for working out. And basically in one weight, you can go from, I think it's 15 pounds up to 50. It's adjustable. So I can get rid of a whole rack of weights on the wall. But they're completely out of stock right now. Nobody has them. So supply versus demand, these things are through the roof if you can find them online. Finally found a pair, to make a long story short, and I paid the guy $350, which is an amazing deal for these things. Now I was just kind of relating it to this last example we saw here. If I found that there were thousands of people selling them for $350, I'm automatically going to negotiate and say, well, everyone's got it for the same price, sell it to me for $250, and I'm going to work my way down there. And it's interesting in this situation when you mentioned primary dealers, they're obligated to buy it. Again, a rigged system, but are they able to say, hey, look, you're selling so much here. Can you give me a better rate? I mean, is that how these primary dealers
Well,
work?
it's an auction. No, it's a great question, Merlin, but it's truly an auction. It's conducted online. So if the dealers are obligated to buy them, but they don't really want to buy them, they're going to put in a low bid, which means a high yield, right? That whole price yield inversion. So if all of the dealers go to this auction with the general consensus of, we really don't want to buy these, but they're legally obligated to submit a yield, they're going to put in a low price, i.e. high yield, to compensate for that.
Crazy. A good question here comes in from Brendan, and he's always got Brendan is one that he just loves the Fed. He's got a tattoo of Powell on his left pec muscle. He's got Powell and he got Yellen on the right, right? He says two questions for you. He says, who owns the Federal Reserve? And number two is money velocity bottoming out? Let's start with the ownership of the Federal Reserve, because it is it's a conundrum because it's not a federal entity. Let's make that very clear for everybody. But who owns it?
Yeah, no, I stress this, so I thank Brandon for the question. The Fed is not a part of our government. Common misconception, and the press kind of fosters that. The Fed is a corporation. It was created in 1913. It is a corporation. There's stock in the Federal Reserve. There's shares of Federal Reserve stock. And that stock is owned by the banks. Right? If you are I know this is a screwy, if you are a federally chartered bank, you are a shareholder owner of the Fed. Yet the Fed supervises those banks. They're owners.
Yeah.
No conflict of interest there.
None at all. None at all. It's so crazy for me to think of how that works. It's just, that sounds like the ultimate stink of corruption.
Well, and there are, there's a lot of theories going back to when the Fed was first created in 1913, almost conspiratory theories around the Fed. I don't subscribe to those, but that goes back to the inception from 1913. This is our third Fed we've had since we've been a republic.
All right, and what about the velocity of money bottoming out? That's an interesting question.
Yeah, and here's an illustration. We've got all of this money that the Fed has dumped in. We started with Helicopter Ben, Bernanke, who put all that quantitative easing money into the economy. Now Powell's been pumping in even more since March. We know quantitatively the Fed has pumped over the last 10 years $7 trillion into the U.S. economy in just pure dollars. And, given traditional economics, we should expect inflation to rear its ugly head.
Right.
But we have to admit it hasn't. And the reason for that is, there's a lot of money out there. And we can measure that through, I've heard you talk about it, as you know, M1, just the amount of cash out there.
Right.
But so we know there's a boatload of cash, but the reason we don't have inflation is kind of the same reason we don't have a strong economy, is we're not getting a high velocity to that money. We're not getting a high turnover to that money. Inflation is really, when money starts moving around, that's what causes inflation. Mm-hmm. And, so I'm going to kind of answer Brandon's question backwards, because it's hard to measure that velocity, and we measure that velocity by inflation. So it's almost a double reversal. We don't have a high velocity, and we know that because we don't have inflation.
Right.
When money starts moving around more, we'll see that inflationary pressures start building up.
The next one was, and actually for the people watching out at home, I pulled up a graphic here, which Bill, you sent me this one earlier, which I think maybe we can talk about. You talk about different Feds, and we can go through kind of the history and talk about maybe some of those different Federal Reserve banks, because you mentioned we're kind of on phase 3. This one is very interesting. If you guys notice back here in 2000, that's the last time we had a surplus. We had a surplus. Ever since then, it has been a deficit, and it's been expanding. There's been a little bit of a, we almost closed it and went to a surplus back in 2006, 2007. But all of a sudden, because of the financial market crisis, we saw a big expansion there. And right now, because of COVID, we're seeing the biggest separation. That I don't know what color those lines. And the bottom one, which I'm saying is blue or purplish revenue line. We're seeing a huge decline in revenues for the government, and the deficit, the spending, is separating significantly here. This, if you were a credit card company or a rating agency or a lender, you'd be looking at this going, I don't know if you're going to be able to pay your mortgage because all of a sudden your income has dropped significantly and you're spending way more than you ever have. That usually ends in a default, in a bankruptcy, which you and I can do, but of course the government will just dig themselves out of it somehow. So I wanted to illustrate that huge expansion you've been talking about there.
No, that slide represents the first 10 months of the year. One of the questions I get in a lot of classes, how did we get here? And we kind of had a perfect storm. We had the government had less income come in. You're right, that blue line at the bottom, less sales tax revenue, less income tax revenue. And yet at the same time, the corona-related expenses just exploded. And the result is at year end, because this is only for the first 10 months, our fiscal year ended October 1st, we came in at $3.3 trillion as the deficit for the final year.
Mm-hmm. It's painting an ugly picture, and some of the comments are great. Jerry says it's a scary movie playing out in real time, which is why I made that intro graphic look like that. I thought it was kind of, but I think to Bill's point, he's right. I did make it look ominous and gory and graphic with this picture here. But, with everything, it's really about awareness and saying, okay, these actions are happening. How might it impact this area? And okay, I will capitalize on that. I think where this ends up, really screwing most Americans is people that don't understand how money works or markets, they're left as a victim of it because they can't position themselves from a perspective of protection or capitalize on the moment because most people are buy and hold investors, and they're the ones that end up getting screwed in all this.
Yep. And if I could jump in, because while we're talking about the fiscal situation, how the government's doing, looking at this, I really got to add a cautionary note of, we were talking about before the session began, of December 11th coming up. The government has kind of screwed things up, and that's nothing compared to what we have potentially on the horizon in terms of a government shutdown on December 11th. We got to keep an eye on this.
You obviously have probably a little bit more on the pulse because people in Washington, and by the way, guys, Bill actually is teaching classes for the Federal Reserve, which I thought was, and congrats on that. It's a pretty amazing feat to be teaching for such a big entity out there like the Federal Reserve. The government shutdown. Let's look at it from two different perspectives. Number one, we'll focus on government shutdown, and then the second piece, we'll go to a listener question on the dollar and stimulus. The government shutdown, this is obviously kicking the can down the road. I think that both of these discussions with the stimulus and with the government shutdown will both revolve around the oldest baby in the world right now, which would be President Trump, who have just gone into compound mode. It sounds like he's locking down in the White House, not doing things he would normally do, putting up a fight there. If we get to the government shutdown piece, what are your feelings that there's going to be any cooperation from him to get things done and keep the government rolling, or is it going to be almost like he's going to force it down to make the new party look bad?
I'm afraid of a burn the village mentality, which seems to be the issue.
Yeah.
When you look at some of the recent appointments he's made in the last 48 hours, go to the Holocaust Museum and see who he appointed to that.
No.
There appears to be a slash and burn. But if I may, just to explain to the audience why December 11th. So just kind of looking at a real quick timeline. The government's budget was supposed to start October 1st. The government works on October 1st to October 1st fiscal budget. So October 1st, September 30th, our budget ended for 2020, and Congress, in their infinite wisdom, didn't give us a new budget. They had a year to work on it. This wasn't a surprise. They just didn't do it. So in typical fashion, on September 30th, at the very last minute, they passed what's called a continuing resolution saying, okay, we'll keep the lights on, we'll keep the government up and running until December 11th. And by then, we'll either come up with a budget or we'll have some sort of a compromise. Well, needless to say, and I live in Washington, and that's my place, is they're not doing anything on this topic. They're preoccupied with an awful lot of other things, like the election's still going on. So here we've got this December 11th clock ticking, which one of three things has to happen. Either the government Congress has to give us a budget. That's unlikely. They're not even looking at it. They have to pass a continuing resolution. That's possible. But the problem here is, even if they do get together and the Democrats and the Republicans do agree to pass a continuing resolution, which is a typical just kick the can down the road, maybe another month or two.
Right.
The fear growingly, and I'll tell you specifically from government agencies here in Washington, is that the president won't sign it.
Right. Right.
In his current slash and burn the village mentality, maybe he'll let the government shut down on December 11th. Again, I don't want to be in the business of predicting this mindset.
Yeah.
But I think it is a legitimate risk we have to worry about.
Yeah. It's scary for me to think about. I mean, obviously, we would love to see whatever the case may be with regards to the election. There should always be an amicable transition from one party to the next and saying, good luck to you. Let's make America great. Let's make the country great. Let's, be the best we can be. I'm going to show one picture here, another picture, because we're talking about the budget and kind of this is kicked down the road. This might be one of the reasons why they can't agree on anything. I found this image to be very interesting, people. This is from Statistica. It's a relatively new one. I believe this goes into Q2 of 2020. You'll notice that the title says Budget Surplus 2009 to 2020. The irony is there has not been any form even close to a budget surplus in that 21-year period. 11-year period. But what should be striking to everybody is the acceleration, how unbelievably quick that sell-off happened from about $1.5 trillion deficit to 5.5 in just a couple of quarters. That is a pretty phenomenal drop. And this is, again, why we're seeing so many bonds sold to service the interest, to service the debt, and that is going to push up that long end of the yield curve. Now, the other piece I want to go to, and maybe I'll get your take on it first, is what are your thoughts on the stimulus piece, right? There had been talks about stimulus, and it seemed like everything was looking pretty good, and it seemed to be put on the back burner. Like, you know what? We might not need stimulus because the economic data, it looks okay. Markets are all-time highs. We're okay. Unemployment numbers are falling significantly. All the economic data seemed like it was starting to get back into a nice place. What's your thoughts on the next round of stimulus?
I honestly feel that we're not going to get one. Opinion. I feel, number one, fundamentally, we've got such a disjoint between the Democrats and Republicans, between where the House is and where the Senate is. And, I'm sorry to sound so negative, but the essence of politics is usually compromise. That's how you get things done. We're just not seeing that. And I also understand, I can appreciate, going back to this deficit discussion, if we really don't need the stimulus, I don't want the markets getting hooked on the adrenaline of this stimulus.
Right, and
because
they are.
Once again, and they are, exactly. But let's remember, we don't have this money. Anything the government passes in terms of a stimulus package is just more money we're going to have to borrow. So it's kind of a vicious circle here. So, unfortunately, as we say this, we know that both in Europe and here in the U.S., numbers are hitting records and things are closing down again. I don't want to be in the business of predicting a virus future, but if things continue the way they are, I think you could make a growing case for stimulus. But again, to do that, we're going to need some compromise.
Yeah, I agree. I would. You asked me 2 months ago, and I think the guys on the show know they asked me about stimulus. I said I don't think we're going to get one, and for a lot of the reasons I just pointed out, which is a lot of the numbers are starting to return to normal. Today
Right.
we did have an unemployment number, or initial claims number, which started to move up a little bit. So a little bit. Nervous there, but of course California just shut down. I know a lot of other states are going to start to go back into lockdown mode, and the last time we went into lockdown mode we had a pretty significant sell-off. Now that might be a catalyst that would get the Democrats and Republicans, the House and the Senate, to say, you know what, let's push through a stimulus deal because unemployment's going to spike here soon. We're going to see a lot of people out of jobs. Forbearance might come into factor again, and to me, I think what you'll get is you will get a stimulus package, but what you won't get is a sign off from the president. And again, I think you're right to your opinion that it's gonna be that kind of the burn the village, like, well, if I'm not president, I'm not signing anything, screw you people. And I hope that doesn't happen, because if we do go into a big shutdown and the markets start to fall, there's a lot of people out there that are gonna really need that stimulus.
Absolutely. I mean, that is the risk in the market now. I couldn't recap it better myself.
And by the way, there was a question here. Let me see if I can bring this one up so I can give the gentleman props, as I always love when you guys send in questions. And the question was early on. Where was it? This is from Chad. Chad says, what do you think the impact on the dollar will be in the next round of stimulus funding? And again, I think we're assuming that we get that round of stimulus funding. But Bill, what's your take on it? We've got this dollar right now, and I'm sure you check out the dollar every now and again.
Right.
It's been going sideways for the better part of 5 months, bouncing between 92 and 95 on the dollar index after a precipitous decline from about 103. What's your take on it?
I do worry that all of this activity is going to be inflationary. We talked about this rising interest rate environment, and this is not something we're just speculating. It's happening. You go back 2 months ago, the 10-year Treasury was yielding 53 basis points.
Yeah.
Last week it almost hit 1%. We traded at 0.93. The yield has almost doubled. So I think the rising interest rate environment is going to show some strength to the U.S. dollar. However, that being said, if the Fed does come in with quantitative easing and, start throwing some more currency out there, some more dollars into the market, that's going to weaken. So, it's kind of the crapshoot of what's going to be the most overriding factor here.
Yeah.
Will we get stimulus? Will we get Fed intervention? I think the real answer, honestly, here is, and we're talking to the audience that knows it best, the real answer here is we just got huge volatility in the interim. We're kind of living headline to headline.
Right. Yeah, and it's tricky to play this one, guys. And I brought up the chart of the 10-year for the viewers out at home. Obviously, you see that the massive decline, and this is the yield on that 10-year. So back in 2019, you're up over 3%. And by all standards, that is historically low as well. We got down to 50 basis points back in August, and now we're creeping back up. Like Bill said, we almost got to 1%, which is a 50% move up in the yield on the 10-year. That may not seem like a lot, but one of the things that has fueled this market rally is real estate, right? We've seen, because this money is so cheap, people out there gobbling up real estate like crazy. We saw a recent existing home sales number that was higher than the previous. It's a record for existing home sales. That's all fine and dandy, but if this number starts to creep up and gets above 1 and then starts to move back even higher, which would most likely happen because of the selling off of the 10, the 20, and the 30, right? They're selling all those in record numbers to get money. That should push those yields higher. If that happens, that to me will start to slowly pinch off the economy. And of course, this is like opening up one of those old-fashioned watches that has 70,000 dials inside. Without one of them, the watch doesn't work. This is just one small cog in that overall market that we call our trading in our economy.
Yep. And I to build on that, and I don't want to be redundant because I fear I mention this too often, but people should be aware that when bankers are pricing mortgages, a 30-year fixed rate mortgage actually benchmarks against the 10-year Treasury. Yeah. That's what they use to price mortgages. So back in August, when the 10-year Treasury got down to 50 basis points, that's when 30-year fixed mortgages here in the U.S. dropped under 3%. Mm-hmm. Now those interest rates on the 10-year are trading back up. Now mortgage rates are trading back up. We're back on a national average. Now, again, that market's local, but on a national average, we're back up over 3%. So this rise in longer-term interest rates, specifically the 10-year, is very much going to affect the real estate market.
Oh, man, there's so many moving parts. And there's some great comments coming through here. I actually love it. Naum says, what about the Forex markets? Yeah, I'll look at that in a second. Jamie says, Trump says the markets would tank and our retirements would go away. He may want to do everything he can to show everyone that he was right. I agree with you. I hate to agree with you on that one. But at this point, since the election, it looks like he's going to lose the election. I don't know. I'm going by whatever the courts say. This guy at a certain point could be, throwing that childhood tantrum and really create havoc out there. So we're so used to his tweets moving the market. Now all of a sudden things have changed because he could tweet and have the power to change things. Now he can tweet and have the power to stalemate everything and create a lot of real issues. It's going to be very interesting going through the actual inauguration next year and see what actually happens. So
I just can't wait till January 20th, one way or the other.
One way or another. I don't care what it is. Let's just move on. Remove this uncertainty. It's just so bizarre. Let's see. And I think it was Naum was asking about, what about the Forex market? Well, obviously, what's this going to do to the Forex market when there's so much manipulation of the U.S. dollar and interest rate products? It's going to create amazing opportunities. Now, don't forget you have the U.S. dollar, which will be significantly impacted by stimulus or these colossal sales of bonds, right? That's going to seriously impact the dollar. But we also have huge moves expected here for the European Union and for the British pound because of their Brexit deal. So the Forex markets are going to experience a lot of great moves. I don't know which way they're going to go, but there will be some great opportunity out there. As a Forex trader, you've got to look at this and say, okay, I just need to be a little more cautious maybe with my stops because things will be moving a lot. But it should create some great trading opportunities for you.
Absolutely. And, we're not the only country doing quantitative easing. You've got European Central Bank out there, UK, as you mentioned, Japan. A lot of countries out there doing quantitative easing, throwing all that liquidity into their economies. It's an interesting time, to say the least.
Interesting question from Brendan. He says, Bill, how does 135% debt to GDP handle rising rates? I don't think it can.
It can't.
Yeah, it can't handle rising rates.
If we were a corporation, we'd be going for Chapter 7 or Chapter 11, quite frankly.
Yeah.
No, and that's the point. And many, it's one thing to say we have a large amount of debt, but we also have the largest economy in the world. What Brandon is pointing out so well is that the debt as a percentage of our GDP is also becoming frightening.
Yeah.
We over a couple of years ago, we tipped over that 100% scale. And, now debt is, as he said, 140% of our GDP. If we were a corporation, that's bankruptcy.
Yep. Yeah, it's scary to think that there's that much debt to our growth. And, obviously we're so focused on growth and making sure our economies grow, et cetera, et cetera, et cetera. But, it's pretty ugly when you look at debt to GDP ratio for the U.S. Now, of course, there's other countries, guys, that are much worse than us with regards to debt to GDP ratio. So, we're not the ugliest one out there, but we're still pretty bad. You look at Brazil, you look at India, you got, a lot of Europe is actually pretty deep. And Japan, of course, is one of the worst out there. Japan, I think, is running at about 260% of GDP.
Some number like that, exactly. What's unfortunate is the rate of our growth. That's the unfortunate part.
Right.
The rate of the growth of debt to GDP. Again, goes back to this whole deficit conversation we're having.
It does. And for Brendan, hey, Brendan's from Canada. You're not off the hook, buddy. Canada's at 115% of GDP. So you're right. You're nipping on our heels. You're following our lead, our neighbor to the north out there.
Not a lead you want to follow.
No, definitely not. Let's all try to go. I would love it if we actually got to a point where we had a budget surplus. I don't even know what that would look like anymore. It happened just 20 years ago, guys. Bill,
and it's interesting when the government does that. By the way, they take that money and they use it to retire bonds. That's what Clinton did under the surplus we had under Clinton. Yeah. So that's a positive.
Yeah, absolutely. And the market returns were great under that administration. I remember doing that from the election show that I did. Clinton's administration had great returns. But okay, Bill, tell me a couple things I want to talk about. Obviously, I like to promote whatever our traders are doing. You have quite a few things going on. I know that tomorrow you have a showcase, which is talking about your signature series that you're teaching for Online Trading Academy. So I want to tell our viewers a little bit about that.
Yeah, thank you, Merlin. I started with OTA about 3 years ago, providing educational content for the OTA Academy. Working with you on the videos and newsletters, and that's kind of grown. And now we've got a 3-day signature series that I host. It's called Bond Aid, Understanding Bonds, Interest Rates, the Federal Reserve, and Our Economy. And it's a 3-day kind of soup to nuts, bonds and the Fed and exactly those topics. We're going to do the third one the first week in December. But in anticipation of those, as many of your listeners know, we also do what's called the showcases, where we do about an hour and a half of content and talk about what's going on, as kind of show you little dribs of what the full 3-day program is. So we have one of those hour and a half showcases tomorrow afternoon if people want to check the calendar. And then we also have another one next Wednesday. So I'm getting in front of the OTA audience more and more on these showcases. And we do about an hour and a half of content for every one of these. And then the first week in December, we'll have the 3-day showcase, the 3-day signature series itself. So, yeah, you guys are keeping me busy during the holiday season here. It's very nice. And I've been real impressed. Brandon and some of the other names that you've already mentioned, I've gotten to know. And it's a good audience. I'm having a good time with it.
Good. Yeah, no, Brendan Wendell has a signature series. Bob Dunn. You also have, Ryan. Oh, gosh.
I'm sorry, I'm not going to be of much help.
Oh, I just totally drew a blank. Oh, man. Sean Reed, Sean Reed has one on options, which is great, talking about creating income. If you guys are interested, I actually had his email up on the screen there. If you wanted to contact Bill, it's bill.addiss@OTAHQ. For those who might be listening to the podcast, it's ADDISS. So bill.addiss@OTAHQ.com to get more info. The easiest way is just to go to tradingacademies.com. That's the website out there, and you can find out the local center that's closest to you and find out more information about his bond aid session. And of course, that one tomorrow is free. So for anybody who wants to join that one, you are welcome to do so. Find out more about what Bill's going to be talking about with regards to the bond market. So A lot to, oh yeah, and David Warner also has a signature series. Yes, Kevin, thank you for telling me that one. I almost forgot. The good news is, in the near future, I'm actually going to be, I think for the month of December, I may be actually hosting some of the showcases. So I'll be interviewing you again.
Excellent. Excellent. I always like the Merlin and Bill show. Anytime.
It adds a nice little flavor to it. But all right, Bill. Well, thank you so much. I hope that you're whatever you're doing up there in Buffalo. What are you doing in Buffalo?
I've got family up here. I'm helping out to winterize because the dreaded word lake effect came in this week. So I'm helping some family members get ready for winter.
What? I'm sorry. I'm from California. What's winter?
Yeah, right. What's lake effect? That's a snowstorm. So believe me, you've got the better quality of life weather-wise. No doubt about it.
Yes, absolutely. And thank you, Josh. Josh has Bashir. Guys, Bashir Chaya also has one. So I think there's like 6 different signature series. Awesome. Yeah, there's
calendar's getting full. So if you check the calendars, there's a number of them. I just wish I could be more help.
Yeah, it's good. I'll let them know. I'm since I'm going to be hosting some of these things, I should probably know more about who they are. But a million things going on in my world. But anyway, Bill, thank you so much for taking the time to come on the program today. Always a pleasure. I love to talk about interest rates and not to paint a picture of doom and gloom. It's just opportunity and how we approach these markets. So thank you guys. Thank you so much for being on. And if I don't talk to you before then, have a fantastic Thanksgiving, my friend.
You too. Happy holidays, Merlin. Thanks so much. Always a pleasure. I look forward to doing it again.
All right. Sounds good. Have a great session tomorrow. Take care.
Thank you. Have a good time, all. Bye-bye. Safe travels.
All right, guys, that was Bill Addiss giving us some insights into the interest rate steepening. I tried to make it look like a scary, nightmarish type of picture, but it's really not. It's just, it's just opportunity. How do we allocate capital to a specific market environment? It's just knowing that there might be some problems from an economy perspective going forward, but I think we all knew that, especially when you look and see how much debt has been accrued in such a short period of time. Pretty impressive. Again, if you want to see Bill Addiss, he'll be doing a signature series for Online Trading Academy. If you are an Online Trading Academy graduate, I think you can just go into My OTA and it will have the list of his signature or his showcase there tomorrow. If you are new to Online Trading Academy and want to know more, simply go to tradingacademy.com and you can find out all the info that you need. All right, what did I want to get into next? Let's see. I didn't have any other listener questions. It was a surprisingly light question day. Let me show you earnings calendars for today. This is some of the stuff that happened today. That way we can kind of wrap up today's show unless you guys have more questions for me. This is today's earnings calendar for the 19th. I thought it was interesting because, of course, I was giving Macy's a bad time and harping on Macy's the other day. Man, look at that. They didn't lose 81 cents. They only lost 19 cents per share. A big beat there for Macy's. It was actually up 1.78% on the day. So nice. Canadian Solar, as I think we'd all anticipate, solar companies probably going to do rather well in this market environment. Not only that, but they posted a nice little profit of 15 cents versus 4-cent loss expectations. I didn't look at CSIQ, so let me real quickly bring that one up today and see how they performed from a technical perspective. CSIQ. And I have the chart up full screen for you guys. There you go. Well, didn't respond too well to that one today. And actually a sell-off on that one on significant volume, almost 3 times normal volume. But all in all, a pretty darn good chart for Canadian Solar. All right, what else do I have? I had Workday. They reported earnings, a pretty big beat. They were up 3.55%. Ross Stores. So all these retailers, which are expected to have dismal earnings, they all did pretty darn well. Even though those retail sales numbers showed a disconnect, in my opinion. It showed declines in clothing companies like Macy's, like Ross Stores, yet the price was moving up on big earnings beats. Now, from the economic perspective, here's what we had happen today. I didn't highlight this one, but you heard me talk about it today, existing home sales. This might be part of the reason we saw a little bit of a positive action out there for some of the indexes. You went from 6.57 million homes sold for the previous month. Expectation was 6.45, so a drop of about 120,000 on the home sales. We actually came out as a beat. We're at 6.85 million with regards to home sales. And again, I think that's due to a lot of people thinking that rates will be rising here in the near future and just gobbling up whatever they can get. So that was a really nice number. Later on tonight, you do have retail sales numbers coming out for the Aussie and retail sales numbers for the British pound. So for those of you trading Forex this evening, be careful and watch for those. Those are definitely market movers. And that's actually today and tomorrow. This last little part here hasn't happened yet. And then here's what's happening for tomorrow specifically with a giant cursor in the middle of your screen. We have for the Canadian markets, retail sales as well. So you kind of have 3 big markets reporting retail sales numbers, and that will do it for your economic calendar for tomorrow. All right, let's see. I didn't get any last minute questions pop through here. Lake effect. I don't know. I don't know. I drive through and I get to see the lakes. I don't know what the lake effect is, but hopefully they do well. Okay, I think that about does it for me. What time we got? Wow, an early one today. What else? Was there anything on my radar that I wanted to talk about? I thought I had some stuff, but I can't remember everything I was going to talk about. I guess we'll just have to wait and see for tomorrow. Now, as I told you, next week I was going to do a series of pre-recorded stuff on patterns. I haven't built a damn thing on it, and my travel plans got canceled because I have to finish some videos. So unfortunately, I won't be traveling, which means I will be stuck here in Southern California. So I will probably do the show a couple of days next week. So we'll do live shows. Don't worry, I'm not out of the woods. I will still try to do some show in the near future on patterns. Also, given the demand and the amount of questions that's come in, I may actually try to build a basic series on cryptos. Probably 3 basic videos. What is it, how it works, and I guess the importance for the economy. So I might do that down the road. Yes, finally Litecoin getting a little bit of a jump. It's probably not going to hit that 300 mark. But if you guys notice on today's chart of Bitcoin, we talk about Bitcoin just really taking the lead here. It was up over 18,000 today. It sold yesterday, and now you're at 17,970. Beautiful move out there for Bitcoin, and a lot of the other cryptocurrencies following suit. So for anybody, Big Ab, you got to throw me some questions, man. I'll try to fill out another 18 minutes, or 17, because I can't quite go 1 hour. I'll do 59 minutes just to appease you, Big Ab. But yeah, that's probably the more significant piece. And it's interesting listening to Jamie Dimon basically say, I just still don't get it. It's like, you run one of the largest financial firms in the world. How do you not understand the beauty of decentralized markets? And probably the reason he's bad-mouthing Bitcoin and cryptocurrencies is because if we all went to a system where we were on a decentralized exchange, we would have no need for a JP Morgan to hold our assets. And that has them all quaking in their boots. So can't expect him to say anything positive about it. If I was JP Dimon, or James Dimon, Damien, I can't remember his first name, it's Diamond, whatever his name is, I would be bad-mouthing it as much as possible because I don't want people pulling your assets out of my company, JP Morgan, to go and buy cryptocurrencies, unless I'm buying it for you. Yeah, Tom, there was an interview he did where he just ripped apart cryptocurrencies and was basically saying, if anybody at my firm trades Bitcoin, I will fire them. There were transactions that happened that day for, I think it was Sweden. We actually had the trade sheets. You could see that Sweden was buying Bitcoin, exchange-traded funds, and trust. And they bought a ton of it that day because Jamie Dimon crushed the price of Bitcoin that day. Oh, the beauty of manipulation. It's so difficult in this day and age to believe what comes out of anybody's mouth about a market, about an instrument. It could all be one ploy so that I can convince you to sell something so I can buy it back at a cheaper price. And that's, I think, what's happening a lot with people like Jamie Dimon. Yeah, Jamie Dimon got into Bitcoin. Good, of course, because she's younger, right? It's not just that the benefit for society and decentralized networks and getting away from government. It's just that the youth understand cryptocurrencies a lot more than the elders. I mean, I still butt heads with some older guys saying that it's nothing but a scam and it's all a Ponzi scheme. Well, you can feel that way. That's fine. But you're starting to see cryptocurrencies infiltrate parts of our lives on a daily basis. I think it's going to get better and better and better. I was playing golf. Sorry, did anyone short Tesla lately? No. I actually I was looking at it today. I was going to trade some options on it, but I decided to move away. Oh, Brendan, you can help me with this one. Okay, XRP, is it worth owning? Oh, it's tough. I still have, I think I have 60,000 XRP. And I'm going to say this, I don't think it's worth owning. Here's why. Initially, back in 2016, 17, I was really big on Ripple. Of course, my average price was like 7 cents or 6 cents or something like that. And the reason I was big on it was because right now we have a system in the United States or globally called SWIFT. And that's basically how you send sums of money internationally. It's slow. It's cumbersome. If you're sending a large amount of money, it could take a couple of days for your transaction to arrive. And let's say I want to send my friend Nick in Trento, Italy. I want to send him $100,000 for something. Whatever. and I do that, it could take 2 or 3 days. The whole time that that's in limbo, they're gaining interest on that $100,000 and making a little bit here and there. But it's a slow, inefficient process that the Fed actually gets records of who's sending any money anywhere. So it's somewhat centralized with that regard, but it's also an entity that is just outdated and inefficient. So initially, what I was hearing was that Ripple was trying to replace the SWIFT system, where you could make transactions for $1 billion if you want in under 4 seconds, anywhere in the world, no oversight, just done instantly like that, with extremely low fees. So instead of me spending, probably $200-$300 to send $100,000, because there'll be some percentage in there, to Nick and Trento, I can send them $100,000, and that might take 2 or 3 days to get there. I could send them $100,000 through the Ripple system, and that would take 4 seconds and probably cost me a couple of bucks. Done, move on, it's there. That's what I thought Ripple was going to be. What you come to find out is it's not a decentralized network. It's kind of a consortium blockchain, if you will, where a few different members have control of it. It's not the project that I thought that it was. And if their job was to replace SWIFT, what I would do if I was the Federal Reserve is I would just create something called the Fed coin, allow people now to do that through my system, and I now can have a record of it, which is exactly what the Fed is trying to do. So I think that they've got major headwinds. The only shining star here for Ripple is they have so much money, because remember, there's over 100 billion Ripple. Only 45 billion of them are in the market. The other 55 are held by the company still, which is scary because if they unload those, the price of Ripple is going to plummet. Now, they have so much money, they can go and buy other companies, entities, and continue to build their organization, which to me is the only saving grace, similar to what I see happening with Tron, right? Tron originally was just a pirate. They were just a copycat white paper. They got a ton of money, made billions of dollars, and with that, very smartly, bought up a whole bunch of stuff real quick before the value of their token plummeted. Now they hold all these assets at nice companies so they can build something out of that. And to me, that's the important piece. I agree with Brendan. If I had to pick between XRP and XLM, which is Stellar Lumens, I would probably take Stellar Lumens or XLM. So that would be what I would be focusing on. Now, we all have our different personal preferences about which one we want to use, which one's best. It's kind of about exploration, and that's just my opinion on Ripple. I sound almost hypocritical because I have 60,000 of them. I did sell off some of them. I wish I sold it all at $3 like I should have a couple years ago. Let's see, what else? And Bonnie, yes, I'm going to get you a question. My inbox has just been flooded with stuff, and I'm flooded with stuff and haven't gotten to it yet. Let's see. Some apps are going to start doing electronic money very well. A lot of them are doing it. Let's see. Pull up a chart of GM and explain it to Big Eb. Oh, do I need to do that? He can probably explain the chart of GM better than I can. This guy knows the industry very well. Now, okay, so you have General Motors. Been doing great. Looking great. I think that, if you're looking at it from just a pure trade perspective, buy pullbacks, right? This looks beautiful. Given the candle over the last 2 days, I would actually expect there to be a little bit of a pullback. You had a shooting star yesterday, shooting star-ish, right? Not perfect, but decent on high volume. That's great. I would actually have expected it to sell off today, but of course we saw rather resilient markets. They started off much worse and then just started to move on up. So we're seeing still some strength in these markets. For me, I'd wait for the pullback. I think you have some unfilled gaps down around that 37 mark, but uptrend's beautiful. It's hard to say anything bad about GM. I'm not a fan of their vehicles so much, but this chart is gorgeous, and I think it's probably going to keep on moving to the upside. So no reason to buck that trend now. You're breaking through all-time highs. What else? I'm getting more interested in Bitcoin by the minute. Well, the train has left the station there, Jorge. I mean, this thing is moving pretty good. It's moving very, very, very good. Super Bowl has to use DraftKings. Do they have to use DraftKings? There's other betting sites. You can make bets on the Super Bowl in any betting site. So it could be, there's a few other competing ones out there. We talked about DraftKings, DKNG, and you guys remember my opinion. I'm hoping you guys remember that. I was saying short this thing. Back here in October, early, someone was asking where you want to buy it, and I said, I'm not buying it, I'm shorting it, and I'd be interested in shorting it. Why? Because you lost most major sports. Now, it's had a beautiful rally. If you look at DraftKings right now, you're actually coming into an area that I'd be interested in buying some puts on this one. And I may actually do this. And I'm glad you brought this one back up. I didn't know it bounced that aggressively. I'd be very interested in shorting DraftKings. I know. It's I know people are thinking buy it because of the Super Bowl. Forget it. I don't care. You've got one sport, and you got college sports now. You got NFL, a few college sports, maybe some UFC and stuff on DraftKings. But other than that, you lost baseball, you lost hockey, you lost tennis. But yeah, I'd be interested in buying some puts on this bad boy if it retraces back up to 5150, which of course is the clinical term for someone who's crazy, because I could be. What was you guys seen the Polestar? You guys seen this Polestar vehicle? I actually seen a lot of it. I never even heard of it. Polestar. I'm going to bring this one up for you. We talked about these different EVs, electric vehicles. Polestar came out, and this is their new vehicle. Check this thing out. That's a pretty good-looking machine. This, again, going right back to what we talked about with the increasing competition for Tesla. This Polestar, they're taking orders right now. It looks nice. And the price, if I remember correctly, is this the one? There was one that was $100,000. There was one that was, oh, look at that. I like that. That's pretty nice. Of course, we know what's great about doors like this? When you have to pull over on the side of the road to go pee, it's perfect. No one's going to see you coming either way. Oh, there you go. Oh, is it Volvo? Huh. I think it looks great. Honestly, this does look like a Volvo. It really does. If you close those doors, that back end has that Volvo kind of Beetle look. I wanted to check the price because I think this one was one. There was one I looked at that was $150. And there was another one that was a little bit cheaper, like $40,000. Yeah, this is going to start at $150,000. It looks nice. It almost has the front end of like kind of American Muscle and the back end of a Volvo. But there's more and more and more of this stuff coming out. I think that the writing is on the wall for long-term Tesla holders. And we talked about this the other day. The beauty of Tesla is that it's not just cars, right? The battery piece is big for Tesla, but boy, look at this. You're right at that $500 mark. I might keep an eye out on this one, and I may actually buy some puts on this one. See how they are. I'll do a 90-day out put on this one. But it's dangerous because when something's being added to the S&P 500, that's going to be a positive piece. And we saw the jump up on Tuesday with the announcement. So you might get some follow through. It might break that 500. So I'd keep an eye on this one, and if it starts to show a little bit of weakness, then I would probably buy puts. But shorting it as this thing is going to be ripping up is a very dangerous thing to do. Brandon, I don't hate you. Buy your Cybertruck. I just think they look absolutely hideous. I could not see myself driving a Cybertruck. I think they look horrible. Oh, but you have bulletproof windows. Yeah, because you drive through your parts of Canada where you need to have a bulletproof truck. I mean, look at that thing. This is like, if you're a 3D designer or a graphic designer, this is what happens to your designs before you render them, right? You know what you render something for? To make it look good. It looks like a wedge. Basically, what's cool about this is if I have a motorcycle, I can pop a wheelie and do jumps over your truck. That's about it. Anyway. Oh, listen to me in my rants. All right, guys, that'll do it for me for today. Tomorrow I have no guests, which means I will have a nice cold beverage. I got a couple trades on that I'm hoping will pan out. We'll lock in some more for tomorrow. If that does, it depends on the grade of whiskey I'll be having on the show tomorrow. Anyway, I hope you guys enjoyed that show with Bill Addiss. Again, he's got a signature series coming up talking about bonds and how bonds are impactful, how we can use them in our portfolios and strategize for this rising rate environment that he calls the steepening. I should have some horror music for that one right there. If you want to know more, go to tradingacademy.com. You can find out the local center. If you are new to Online Trading Academy, contact them and say, hey, I'd like to go to Bill Addis's showcase, which will be tomorrow, where he'll talk more, about an hour and a half, about what that class includes and give you some insights into how these bond markets function. You'll probably get a lot of stuff you got out here today, too. If you wanted Bill's email, I think I had it up there. Let me just bring it up here. There you go. It's bill.addiss@otahq. That's the one right there, .com. So BillAddiss@othq.com. All right, that's to do for me. Again, I hope you guys enjoyed it. Thumbs up if you liked today's show. I hope you liked today's show. It was a fun one. If you didn't, well, you can give me a thumbs down. That's fine too. But if you do, I would love if you told me why. You can always send in emails at TraderMerlin.com or just email me, TraderMerlin@gmail.com. However, if it's got Trader Merlin in it, I'll probably respond. Make sure it has one eye, not two, like that scam artist on Twitter who's trying to get people to sign up for stuff. So I will stay away from that scam artist. Get yourself 500% rate of return in a week. Just sign up today. Oh, the scumbags are out there. Anyway, thanks guys so much. Have a fantastic weekend. Hold on, it's not even that weekend. Have a fantastic evening. I will see you Friday. Take care.